Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast, the alternative wealth-building podcast for high-income earners. My name is Christian Allen, here with my co-host, who we all lovingly know as Rod the Pod Zabriskie. Rod, what's up?
Hey,
There is the pod.
Yes. How are you doing?
I'm a little grumpy, if I'm being honest.
Oh, well, we do want you to be honest. But here's the thing. I think I have the right antidote for this grumpiness.
Okay, tell me. I'm
It's the
excited to
topic.
hear.
We're going to talk about college planning today.
Rod.
It's the
Rod,
thing.
I've been telling you how
You
bored
need.
I am anytime I get into the college. No, I'm just teasing. Like I kind of, okay. It is kind of a boring topic. Like, let's be real, right? However, it's a personal finance show and it's an important topic. And my guess is there are a lot of people who are listening to this that strongly believe in education, the value of education, planning and preparing for it. So for that reason, Rod, we want to make sure that people are going to, if you have to go through the boring kind of conversation around college planning, you might as well at least do it right.
Yeah, absolutely. Its moment
That's
has come.
my attitude.
Yeah,
its moment
absolutely.
has come, and hopefully it will go relatively quickly. No, I'm
Yeah.
just teasing. Okay, well, I'm excited. We're going to talk about college planning today. But before we do that, Rod, I just want to remind everybody that our next live webinar is going to be on October 12th at 11 a.m. Mountain Time. It is called From Owner to Investor, How to Plan, Prepare, and Profit. Okay, and our intention is to have a special guest with many, many years of expertise and experience in the business space. So I think it'll be good.
Absolutely.
But we do need to reach out and make sure we get him, Rod. So have you done that yet?
Not yet, but we'll get him.
We'll get him. Okay. Sounds good. Well, look forward to that. So Rod, let's get to our topic then. I actually want to say the title because I really put a lot of effort into these titles. So
Yeah.
Smart Money Moves, how cash value life insurance can turbocharge your college savings plan. Although, Rod, did I come up with that or did you?
You must have.
Okay. I probably did. I like to put a lot of effort into these names, so I probably did, but sometimes I forget. Okay, I'm excited about this though, Rod, because like I said, even though it's a boring topic, we're gonna make it a little bit more fun by making sure that we're throwing out the bad stuff, because there is a lot of bad stuff in the college. And I think that might be the reason I'm so bored of it. Like it's like, okay, you want to start planning for college, you have two options: 529s or Coverdell savings accounts that like haven't been used in 50 years.
Yeah.
Right? Like those are the options. Okay. Obviously those aren't the only options. We're going to talk about some others. Okay, but since this was more your topic idea, Rod, why don't you set the stage for your thoughts around college savings, college planning, and give us kind of an overview of where we're going to go with this conversation today.
Yeah, absolutely. Now, especially because the majority of our listeners are high income earners and put high value on education for their kids, want to make sure that they're ready and able to go. And because of in that high income space, it's harder to qualify for the federal aid, the grants, those kinds of things. You just kind of have to take it on yourself, right? But
I wasn't even high income growing up, and and maybe it was just that I didn't know how to do it, but I didn't qualify for anything. I remember going into I came from, I always tell people my dad passed when I was out in Virginia for a couple of years. I come home and I'm getting ready to start college. I have like very little money, right? My mom has her savings and stuff in retirement, but like I don't have a lot of money. And can I just tell you, we were like a single income household, and I still struggled to qualify. Now, to be fair, we weren't like poor. My mom had the house paid off, and $500,000 to $700,000 to live off with her, and including some Social Security. But she was like okay, but it wasn't like we were like living high on the hog. And there was, at least it felt like there was no help for me. So this is just an interesting thought going into it.
Yeah, well, and I'm in a similar boat. There was a high culture of going to college. All 8 of us siblings graduated from college.
That is fantastic.
However, it was made clear that for my parents, they're like, "Okay, you're not getting any help from us though. So we want you to go. We want you to succeed. You're gonna have to work hard and get some scholarships. That's gonna be your thing."
And that's how you guys did it, right?
Yep.
Okay, so this is gonna be a little embarrassing to admit, but actually, I'm quite proud of it. So I am a 4-year college dropout, right? So 6 of the 7 kids in my family are college graduates. I am the only one who did not graduate from a 4-year college. I kind of ended up taking a more like niche route and went straight into the financial planning world.
Yeah.
But can I just tell you, I'm very proud to be the one college dropout in my family.
I love
it's been like, it was the best decision I ever made. That said, I do put a high value on education, just like the rest of our listeners.
Sure. Yeah. No, and that's the thing is you always have sought out education. You're to the school of, I don't know if hard knocks is the right word,
it's
but
like alternative style. I usually just like dive into it and, but I did do some stuff like in the college. I went to like the College for Financial Planning and the American College, some things to get like specialized knowledge in this space. Yeah. But man, can I just tell you, Rod, when I got to college, I know this is a little bit of a tangent here, but I'm sitting in general ed and I'm just like bored out of my mind. And I'm thinking, how do people get through this? And I managed to get through one semester and I was like, that's it. I'm starting my career. I got in with a financial planning firm early and dropped out and never looked back. And can I just tell you, best decision I ever made. But that's not, I want to be really clear. I'm not trying to suggest that everybody should go my route. There's a lot of people who will get more value. It just makes more sense to go the education route. So anyway, education is critically important. And I know that I've been all over the place, but I do believe that education is really important.
Well, and I think your little diversion there actually is very helpful because we're going to talk about a 529 plan just so we can contrast it against the other stuff we're going to talk about.
Okay.
And one of the challenges with the 529 plan is if your child doesn't end up going to college, what are you going to do with that money? Right now, it just sits there. It becomes like,
oh yeah, my parents, they've been saving for years and it's just sitting in we can't get it out.
Yeah.
I'm just kidding. Okay. It's not really that, but you make a good point. Yeah. Okay. So going back to the catalyst behind this, like obviously we're proponents of life insurance as an asset, especially for high income earners because of the additional tax benefits and the ability to put more money in and those kind of things that you can't get from some of these other built-in tax incentives from the, that are just kind of put out there from the IRS or from the government. I forgot where I was going with that, Rod, but let's jump into, I remember we're going to focus specifically on how cash value can create a pretty unique element in that, right? Because here's the deal. People who are listening to this know something that most people don't know, Rod. Yeah. They know that the policy is not or does not necessarily have to be the investment.
Yeah.
And once that idea gets through your head, like things really change, right? Yeah. Because now I'm thinking I can now do my college savings, but I can invest in real estate or any other asset class I want to instead of this world where I've got to be in like a very defined, like the 529s, they do them by state as an example. And it's like, you have like 7 funds inside of that 529 plan. And that's what you go to. Well, what we're going to show is an opportunity to be totally free and opportunistic and invest in anything. And can I just tell you, that is the reason that we like life insurance for college planning, or I should say one of the many reasons. Okay. Yeah. I'm probably like not doing a good job at saving the meat of it for later, but
throwing out these teasers.
Yeah. Well, I don't know if it's teasers. I think I'm just like going past the teasers and just like giving the whole shebang. So I'm going to try to stop doing that. Rod, where do you want to start with this conversation?
Well, let's start with the 529, just so we can establish kind of where most people go and why do they go there? Because that's all they know.
Okay. What is it and how does it, like, give us the gist of what a 529 is?
The 529 plan is basically the state saying, hey, we want to encourage you to put money aside for your kids to go to school. The state is saying, hey, we value education. We want to make it beneficial for you as you're setting that money aside. So they set up these 529 plans. And when you put money into it, the money ain't going into it is actually after tax from a federal income tax standpoint. Some states will actually give you a tax benefit going in. So after tax going in, and then as it grows to what they call tax deferred. You don't get a 1099 at the end of each year as the money grows. But then as you're taking it and you're using it for, they call it qualified expenses, tuition, room and board, that kind of thing, whatever the child needs to make it, at school. And so then when you take that money back out, it comes out tax-free. So hopefully between the time you put it in and the time you're taking it back out, you've had some growth in it, and you get to take that growth out without paying any tax on it.
And can I just say, like, that is basically, well, I was going to say it's basically a Roth IRA in that situation, right?
Yeah. So
that is valuable. Like, especially if we believe taxes are likely to go up, then there's just an element to where that could be a real tax benefit, with the caveat being that if you spend it on qualified,
that's right.
I was going to say medical, qualified educational expenses.
Yeah. Right. And so now as we get into the pros and cons of this, the pros are that you get that kind of tax benefit. And again, especially if it's money that you're setting aside and it's going to go toward education expenses anyway, well, why not take advantage of the opportunity to get those tax benefits, right?
Yeah.
Again, we'll contrast that against or compare this against the whole life and tell you what other options you have. But the point is that's why these 529 plans exist. Okay. But then the question is, are you happy with those handful of investment options that you're given by the state? Somebody out there, some guru, went and handpicked a few different places, basically the equivalent of mutual funds. You can put that money in, have it invested while you're building toward the time where your child's ready to go to school. And so now, okay, as you look at those options, are you happy with that? Right? Not much in terms of variety of what you could invest in. Number two, do you like having money sitting there in the kind of stock market subject to the volatility? Number three, what about the timing? Right? If your child is going to school and the market's crashing, you're just hoping that it recovers quickly while they're in school. But the fact is you're actually forced at a place where you have to sell low because the time came, right? It's time to take the money out.
Okay, Rod, can I give you a little pushback on that one?
Sure.
Just for food for thought here. So to me, if I'm looking at the other side of that, I'm thinking that's pretty easy to plan around, right? Like, like maybe not in that very moment, but maybe the situation is that to make sure that you are not pulling when the market's low, you have some sort of like little side amount of money that is totally uncorrelated. I'm talking about a really great retirement planning strategy here, aren't I? But you could just take that a little bit of money X aside, and that way you give the college savings plan an opportunity to recover. So like, here's the better question, Rod. I just talked about how you could go and invest in real estate or other things. Like, isn't it more likely that you might have a difficult time getting money out of that side, the alternative space, versus the traditional? I'm just throwing it out.
No, it's absolutely possible. And so what I'll say is this: as always, be smart, right? Be smart in the way you're investing, the liquidity, the when you need the money, all those kinds of things. Absolutely.
I have a solution for this, for the problem I just put out there. So remember how I said it was really easy to put together a side fund in your traditional investments? It is equally easy to do that in the alternative world. So here's what I would suggest. I would go to the place that I felt more comfortable and confident in producing a return that would help me get to the place that I wanted to be. So that's basically a long-winded way of saying, for me, I would still go into the alternative world, even if I had to deal with some potential issues around like liquidity. Although you could plan, right? Like, it's pretty easy to say, my kid is 7 years old today. They're going to be going to school at 18. I have an 11-year horizon. In a traditional mutual fund, it's just kind of there and going up and down. You might be in a specific, set of real estate deals, and you know that you've got to be exiting by this date. And so you plan appropriately. But anyway, my point is to say that, you can, even though I brought that point up, I think it's legitimate. I think the legitimacy exists regardless of whether you're going traditional or alternative. And so, well, we lean alternative most of the time.
Yeah. Yep. Plan accordingly, right? On the timing, everything else. Yep. Okay. And then the last con that I'll talk about on the 529, then we'll move on, is, we hit it on earlier, that money is designated for education and only education for that child. Like when you set up a 529 account, the designated beneficiary is the child. And so what are you going to do if they drop out?
If they're me and they drop out?
If they drop out, or I'm thinking about my son Spencer, he decided to join the Army. It's not to say he won't ever go to school, but for at least for now.
Well, and what if the military pays for his school? Then
exactly. Yep. That is exactly the kind of thing. So, or you get a scholarship, like they really do succeed.
Yeah, that is a little weird. Okay, so this is gonna sound. I didn't prep on the 529s coming into this. So remind me, Rod, if I'm that person, I don't use the money, what happens?
It basically becomes a retirement account.
Okay, that's right. I knew that. Thank you for the reminder. So it's not like you're having to wait. You don't have to wait till like it doesn't have to be like passed on and then they die and finally the money comes out. That would be crazy. But you're saying once they get to like the 59 and a half, then it could be used as a retirement. So, okay. So that's helpful to know. We want to be fair and complete.
Yeah. The money doesn't go away, but
it doesn't go away. It's not, I mean, it's still there. You just have strong limitations on when you can take it, that kind of thing. Okay.
Yep.
Okay, cool. Where do we go next?
All right. So that's the 529. I think that's as much as we want to cover there, because what people came to hear about is how we can use cash value life insurance as an alternative to that, as an additional option that maybe people didn't realize or think about as something they should consider as it relates to college planning.
Rod, what they came to do is learn how to use cash value life insurance to turbocharge their college savings plan.
Yes.
They want to make smart money moves, Rod.
Absolutely.
Okay. So we're not going to talk about Coverdell, Rod? Coverdell college savings
plan? I didn't bring it because like you said, it's like 529. There are some nuanced differences, but
except it's worse, right? And so it's like 529, but not as good and basically has become obsolete.
Yeah. Right.
Okay. All right. Well, we won't talk about Coverdells. But they do exist. So
yeah.
And I can't remember why they were named that, but I did know that once upon a time. Okay, Rod. Well, then let's move into let's set the stage for how life insurance. And you're saying, okay, one of the things I've noticed, you keep saying whole life insurance. Do you care whether that's traditional whole life insurance or universal? Like, we don't typically do well. From a belief standpoint, we typically stay away from variable life insurance, but we do play in both the indexed and traditional whole life space. Is this only for whole life? Like, don't touch college savings in a life insurance policy is completely illegitimate unless it's in traditional whole life insurance. Is that what you're saying?
No, it's a fair point, because you could go the IUL route. I think the reason why I was doing that is because what we're going to talk about is, and you already kind of hit on it, doing this in conjunction with other strategic planning and other things that you're doing in your investing. Okay. So for example, the investment optimizer using a whole life policy is a great way to kind of dual purpose that policy, using it for the investing and using it for as
kind of planning. So you're saying basically, because in the investment optimizer, we typically use whole life insurance. Not that that's the only way to go, but like there's some minor drawbacks around using universal life insurance as an opportunity fund to invest out of. But what you're saying then is that because in the investment optimizer, we're using whole life insurance as our base policy to invest out of, our opportunity to invest from, that just kind of translates to be similar, because the likelihood is we'll be doing the same thing with our college planning money. Is that what I'm hearing?
Yes. Okay. Yep. And then also one other point, and again, you kind of hit on it, is the idea that it's not correlated to the market. The whole life specifically is not. IUL is
mild.
Not. Yeah. You don't participate in the
uncorrelated.
Losses. Yeah. But you're not. But it is. I mean, you're it's linked to what's happening in the market. Depending on what's happening there determines how much growth you get in your account.
And this is something that people don't typically understand is it can be possible to lose money in a universal life policy, whereas in a whole life policy, you just can't, right?
Right.
And a year to year. Now, when I say lose money, I don't mean like lose money from the return, but I could lose money in a given year based on like if I got no return, but I still took on cost.
Yep. Right. So you're not participating in the losses of the market, but yeah, you had some costs in that same year where you didn't earn any interest. Therefore, you lost a little bit of ground
on the other hand, Rod, we could have years where you drive a 10 or 12% return and you're using it to invest. And so you could get like a double whammy. Yeah. Bang, bang.
It's true.
Okay, cool. Sorry. All right. I just wanted to make sure we like laid out all of the facts there.
Yeah, absolutely. Well, let's talk first about the tax treatment. And that is because what I described on the 529 plan is exactly the way the tax treatment works on the whole life policy. In other words, in life insurance, cash value life insurance, we put money in after tax. It grows tax deferred, which again means we're not getting a 1099 each year to pay in tax on the growth as it goes. And then when we access it and take the money out, whether it be for college planning or any of these other purposes, investing, retirement, etc., it's all going to come back out income tax free. So from a tax perspective, they're exactly the same. You mentioned the Roth earlier. They basically act like a Roth.
With a couple of caveats, there's not nearly as many rules and regulations around life insurance and how to access it and how much money you can make and how much you can put in as there is in a 529. But the actual tax treatment, assuming you played the 529 out to its planned conclusion where you pay for educational expenses. In that situation, it does end up being exactly the same as what we're talking about here. Okay.
Exactly. So then you ask yourself, okay, if the tax treatment is basically the same, then which do I like better for all of the other features that are available? We talked about the investment options on the 529 side. Now, in terms of investment options inside of the cash value life insurance, you brought up variable life. You could do that, and that would be actually kind of similar to what the 529 was doing in the sense that it's kind of moving with the market up and down as the volatility happens, hopefully more up than down. Whereas then you have the IUL where you have that downside protection and you participate with the gains up to a cap. And then you have whole life where it's completely uncorrelated. You have a guaranteed interest plus a dividend that has nothing to do with what's going on in the general kind of stock market. So, and then going back to a point, a teaser that you made earlier, where we don't treat life insurance like the investment necessarily, right? Could you do that? Absolutely, you could just put it in there, wait for college to come, and then take the money and go use it. However, in the meantime, if you were using one of our strategies, the investment optimizer, where you're taking that money to go out and invest in anything you want, real estate, your business, whatever, someone else's business, mortgage funds, whatever, so that you're creating that growth inside of it or you're using it in conjunction with that and cycling it back into the fund so that you have more money there that's available for the college when that time comes. So when you take some of those differences, and again, we'll hit on a few others here in a minute, but take those differences, then you're deciding, okay, it's the same tax treatment, but which do I like better for the other features that are available?
I had a thought as you were going through that, Rod. You're talking about how we don't typically use life insurance as the investment. That changes when we talk about capital avalanche, leveraged.
Yeah.
So the thought that came to my mind, and maybe you're going to talk about this, but does it or can it make sense for college planning specifically to use a leveraged policy, use premium finance as a way to plan? Let's say it's 15 years down the line.
Yeah, that's really the key. It's the timing, because And it depends on how you fund the capital avalanche. If you're just funding 1 year and then financing everything after that, then you're going to need a 12 to 15 year time horizon before you're ready to start taking the money out. If you were to fund 2 or 3 years first and then start the financing, then you might be 7 or 8 years to where you could start taking the money out. But if it's only a couple of years away to, your child is 16, then yeah, capital avalanche is not an option that you would want to consider. And life insurance in its purest sense, someone might say, well, for the same kind of thing, a 15, 16-year-old, it's not appropriate to start a life insurance policy for them if you think it's going to be used for college planning, right? You have those already costs in the first couple of years. But what I would say is that's true if that's the only purpose for your policy. If you're saying, hey, all the money I'm setting aside for my child for their college, I'm putting in a life insurance policy. They're 15. I need to be ready in 3 years to start taking the money back out.
You're right.
Then I agree. That's not a good plan. However, when you do it in conjunction with the investment optimizer, you're using money that you're going to be sending the child to college with, and all of the money that you're putting in for your investing is all going into the same plan. And then you're starting to turn that into investments, flow that money through it. Well, that creates a very different scenario because we're not relying on the policy by itself to now cover the college planning. For example, let's say you put a couple $100,000 into the policy over those couple of years. Maybe you've taken some loans to go out and create some to invest, and then you reserved a few dollars there that would be used to get the child started in their college. So you take a loan against the policy to go and pay for their tuition, their room and board, all that. And then the investment returns that you're getting from your real estate or whatever, kicking that back, that not only is paying down the loan that you used for that investment, but it could also be used to pay down the loan that you used to pay for the child's college, right? So in other words, it's just a sequencing thing. You put the money in, you use it to go out and invest, and then the returns coming back are ultimately what's paying for the child's college.
And I would actually look at, I hear what you're saying. That makes sense. Another thought that was coming to my mind as you're talking about that is that the loan on a life insurance policy doesn't affect the plan. So like, it doesn't actually matter if I take a loan 2 or 3 years in, as long to the extent that I'm planning to keep the policy long-term, then that even that short-term duration doesn't really matter, right? Like what would matter is if I was genuinely taking, if I was taking some of the value out of the policy that exists, but we're not, right? All of those elements exist regardless. If I said, you know what, I'm going to start the policy today, I'm going to put some cash in it, that I'm going to cash out the policy, terminate it 3 years down the road, then yes, that would be a bad idea because I would lose money on that deal. But if I instead kept that money or kept the policy, even if I kept it for 7, 8, 10 years, I probably will keep it indefinitely. Like that's just what people do. But if I were to do that, I would still be able to recoup the value, even if I used the money for college during that time. The only caveat being that I didn't terminate the contract, because that's what stops the compounding of the policy.
Yep. Yeah. And then I talked about your investments helping to pay down that loan, but also think of this way: when people are at the point where their children are in college or maybe just recently graduated college, they're also typically in their peak earning years where they have more money that they can be, dumping in toward retirement planning. And so retirement cash flow planning. And so using those funds to also pay down the loan is a possibility as well. So again, it's just a timing or a sequencing of the cash and how you're using it to pay for things.
Okay, Rod, I think that's probably a good stage setter. Do we need to talk at all any more about how like the life insurance itself works, or do we feel like we've hit on that in enough detail? Any other points on your mind?
Yeah, I think we've hit on that. And so I think these first initial points, the tax benefits, the way it grows, So let's talk about the financial aid implications. Now,
Yeah.
I say this realizing that a lot of high income earners, it doesn't matter what the asset side looks like. You probably just are not going to qualify for financial aid. It's just kind of the way it works. However, let's say that we have someone who is a high income earner. They are selling their practice or something that just happens to coincide with when their children are going to college. And so they have a low income for at the time where now they're applying for financial aid. And so now it's really all about how their assets are allocated. Well, here's an interesting point. The money that you have in a life insurance policy does not count toward your assets as it relates to financial aid. So when you're filling out the FAFSA form and they're saying, hey, give us all a breakdown of all of your assets, they ask for cash in the bank and mutual funds, money market, those kinds of things. But it does not include, and it specifically excludes any money that you have sitting in a life insurance policy.
Oh, that's nice. That's valuable. And here's the deal. Maybe that information isn't going to be like pertinent for you, but certainly you could have employees or friends or anyway. So there's a lot of value in understanding how that works, because most of the world is looking for the most efficient ways to pay for college. And of course, like the amount of debt that comes out of college is insane, right?
Mm-hmm.
So we have this massive problem in the world as it relates to paying for college.
Yeah.
The more of us that actually know some of the ways to help, help those, especially kids who are trying to get it. Anyway, if we can do that, then, more power to the next generation, obviously. Okay.
Absolutely.
Speaking of the next generation, Rod, and maybe we're going to talk about this. Maybe you weren't ready to talk about this, but I was thinking, why don't we talk about the value of having a death benefit in a college savings plan, which again,
yeah,
when you initially think about that, you would think there isn't really any benefit. Like I don't see the value in it, but I think there actually can be. And especially if you're a high income earner, because this kind of thinking is likely already in your milieu anyway.
Yeah. It's a great point. And a couple thoughts on that. Number one is that life insurance planning, like by itself, should always include these types of things, right? If you're thinking about it in terms of who is economically impacted by me dying, right? Obviously, the income that you bring in, income replacement is often a thing we talk about, but then it's also all of the other things that wouldn't be able to happen in the same way if I'm gone. So, and in this case, college planning is obviously a big part of that. So a lot of people do include or kind of this college planning inside of their life insurance. Like when they say, how much life insurance do I need? How much should I leave behind if something happens to me? Then this is obviously a big piece of it. So, the money that's in the policy, we talked about kind of the tax treatment. Well, when it pays out as a death benefit, it also pays out income tax free in that situation as well. So now that money is there, it's available to be used. And so that's kind of maybe the most obvious piece.
Okay, Rod. I was really trying to set you up so that you would say the word multi-generational.
Oh, okay.
Because people like multi-generational things, right? So maybe what Rod described there in a lot more words was that life insurance is multi-generational. So here's the deal. Even if you don't use it, whether it's, obviously if you don't use it, it carries both a cash value and a death benefit. You get the larger of those. You get a tax-free death benefit, which then kind of creates this compounding effect from generation to generation, even if it's specifically focused on college, right? You could help pay for college for generations to come. Or it could be a more generalized assets that goes to help you, create the multi-generational wealth that you're looking for. So I guess what I'm saying is it's like a much more efficient asset from that standpoint. And again, especially if you're a high income earner and someone that thinks about investing, that thinks about building wealth, like the chances are you're going to be in a position to get more value from that element of it being multi-generational because of the death benefit and the tax benefits that go with it, that it suddenly becomes, more valuable by a long shot than, what you can get in like a 529 plan, as an example.
Yeah, absolutely. There's a term that we've used in the past. We called it perpetual family banking. This idea that the investment optimizer is...
That sounds too much like infinite banking to me, Rod. I don't know.
Perpetual investment optimization.
There you go. I like it. That's better.
Okay.
That's better.
So, and the idea is that we're using the life insurance in conjunction with the investing, and when one generation is passing on, then this extra death benefit comes in. So you have this kind of like prototypical compound curve with spikes when the extra death benefit comes in. And so multi-generational education planning could absolutely be part of that. You're doing all this maybe inside of a trust. And so as part of that trust, you have instructions there that say, hey, this, some of this money is going to be allocated toward education planning for the grandkids and whatever. So yeah, I like it. You know
what? Here's the really good news. So I'm getting away from this multi-generational element. I'm going back to just the very basic element of putting money in life insurance to use for college planning.
Okay.
At the end of the day, you can put it in there and use it for whatever the heck you want.
Yeah.
Like that's probably the biggest part, right? So if you're like, the only way you would consider a 529 over life insurance as that vehicle is if you, one, were more of a traditional investor, and that was like your focus, right? Because you might look at that and say, well, I'd rather go in these, passive mutual funds than go into a life insurance contract that either gets me, let's say, 5 or 6% on a tax-free basis, which may actually be better than the mutual fund anyway, but we don't know, right? And maybe they don't want to like do the investing themselves. So like there are some potential reasons why someone might not want to, but basically outside of that, it just makes more sense because again, you're not hamstringing yourself to using it for one purpose. Rod, is there income limits on 529s? I can't remember.
I haven't seen anything that indicates that.
It's been a while, man. I told you I didn't come in as prepped as I probably should have
on
been.
The 529.
On the 529 specifically. Okay, cool. But anyway, I guess my broader point just is that if I'm a wealth builder, if I'm an investor and a saver, I don't want to be hamstrung into one thing, right? Like the fact that I can use my asset in any way I want, like that's what we typically see. People don't normally, if I'm being honest, I don't think, and you could, you meet with clients now and I haven't for several years now. So like, but my thought is that most people who are starting policies for kids are thinking, I'm going to start a policy for my kid so that it can be used for college or to start a business or to buy a first house or to do all these things. They're not usually thinking, I'm going to start this policy exclusively so that they can make sure that we have college money for them. Is that fair?
Absolutely. Absolutely. Yeah.
And that might be like the biggest and best selling point, right?
Right.
Freedom, flexibility, both in terms of how and when you use the money and how and when you invest the money.
Yeah, because you were speaking of it in terms of being hamstrung as the parent. You don't want to also hamstring, or at least you don't want to kind of put that unnecessary pressure on the child. Like, hey, all this money is here. All you have to do is go to college and you can get it. Right? Like, that's maybe not.
Maybe I would have gone to college had that happened.
Forced you to stay.
That would have been enough to like be motivated. Be like, all right, I'm going to sit through this painful English class no matter what.
And your temperament is such, you might have needed a little extra help on the backside to kind of get your wits back together.
I might have. You're probably right. Okay, well, this has been fun. Is there anything else? It's actually been more fun than I expected, Rod. I got like a smile on my face, got excited. I'm not nearly as bored as I thought. This is great.
Well, there's one
is there anything else? Okay.
I've thrown in some real life examples. I want to do one more. And it's really an extension of what we've already talked about, because if someone is doing this, they're putting the money in the investment optimizer kind of plan, and then they also use that plan to fund the college, and then they kind of refill the bucket using their investments or their higher income later once the kids get out of college. And then we always talk about it as phase 2 anyway of the investment optimizer, and that is using it for retirement cash flow planning, right? Tax-free income coming back out. And again, just maybe reiterating the idea that all of that is happening with the same policy that you set up originally when the kid was whatever, 5, 10, 15, whatever age they were, for as an investment optimizer. You dual purposed it. Now you triple purposed it, right? For all these other things that, so as we live our lives and as the different phases of our lives come through, that's the cool thing about an asset like this is it can be used, and it can, the strategy around what you're doing with it can evolve as time goes on.
You know how I'm feeling right now, Rod? I'm feeling like we have turbocharged not only our college savings, but also our retirement and investment plan all
Beautiful.
in one.
Yeah.
Amazing.
Yeah. People would expect nothing less of that than us. From us.
Okay. All right. Well, this has been fun, Rod. Thanks for pulling us through the college savings conversation. Thanks everybody for listening, and we will see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.